Hi guys, I'm EP. In this video, we are going to see what is a financial ratio analysis. As for now, we have seen what is a fundamental analysis of a company, and in that fundamental analysis, we have seen what is annual report, and in that annual report, we have seen the financial statement of the company. That is profit and loss statement, balance sheet, and cash flow statement. With that financial statement, we can only know what the company is doing and how stable the company's financial performance is. But we cannot conclude it how well the company has performed. For that, we need the financial ratios. The financial ratios help us to compare the current performance with the past performance, as well as we can use it to compare the company's performance with the other company within the same sector. Okay, let's get started. Okay, basically, we can divide the financial ratios into three types. That is profitability ratio and the leverage ratio, and third one is the valuation ratio. Okay, the profitability ratio is nothing but how well the company is making profit and whether the company is making progression in their profit or not. Okay, that and all will come under the profitability ratio. We should always calculate the profitability of a company, because if only the company makes the profit, then only the company can expand their business or giving the dividends to their shareholders. Okay, so the profitability is very important thing in the company while we are going to invest it. Okay, and in that profitability ratio, we are going to see what is a EBITDA, that is earnings before interest, tax, depreciation, and amortization. Okay, let me explain. Typically, in a profit and loss statement, what all will be there? There will be a revenue, expense, tax, and the net profit. Okay, in that revenue, there will be operational income as well as other income. Okay, and in that expense, let us say the labor salary and the raw material and interest, that is financial cost. Okay, as well as depreciation and amortization. What is depreciation and amortization? Okay, let me explain. Okay, in the previous example we have seen about the restaurant business. Okay, for that restaurant business, if we do a P&L statement, then in the depreciation and amortization column, what and all comes in the restaurant business. In the restaurant business, what and all we use oven, cookers, burners, likewise. Okay, but in the long term it will going to depreciate in value. Let's say if we buy a oven at 1 lakh rupees, same oven after 1 years we cannot sell that oven for 1 lakh rupees. We can sell that oven only for 90,000 rupees. Okay, that 10,000 rupees is comes under the depreciation and the amortization. Of the depreciation is for the tangible assets that if we can touch and feel, and amortization is for the intangible assets. That means if the restaurant business has a software for their billing, likewise the license for the software they are using going to expire in the long term. Okay, that also comes under the amortization category. The depreciation is for the touching and feeling the asset, that is tangible one, and the amortization is for intangible assets. Okay, now in the EBITDA margin we are going to calculate the earnings before interest, tax, and depreciation and the amortization. Okay, for this there is a formula. Okay, to calculate the EBITDA margin, first we should know what is EBITDA. The formula for EBITDA is operating revenue minus operating expense. Okay, the operating revenue is nothing but total revenue minus the other income. We seen that in the P&L statement, under the revenue, what and all will be there? There will be a revenue from operation as well as other income. If we add the revenue from operations plus other income, we will get the value that is called the overall revenue of the company. Okay, and to calculate the operating revenue, we should minus the total revenue, that is this value minus other income. Okay, likewise for the operating expense, in the expense categories, what and all we have seen, that is salary for the labor and the operating and the financing cost and depreciation and amortization. Okay, and if we calculate all the expense, that will be our total expense. Okay, to calculate the operating expense from the total expense, we should minus the financing cost and the depreciation and the amortization cost, then we can get the operating expense. Now if we subtract the operating revenue and the operating expense, we can get the what is EBITDA, that is earnings before interest, tax, and depreciation and the amortization. Okay, to calculate the EBITDA margin, we should divide the EBITDA divided by total revenue minus other income. We already seen this. What is the total revenue minus other income is operating revenue. Okay, the simplest way is EBITDA divided by operating revenue, so that we can get the EBITDA margin. The EBITDA margin should grow year on year. Okay. Okay, in the previous example, we have seen the Infosys P&L statement. If you see in the website called Grow, they have already calculated everything. Okay. Now we are seeing the EBITDA for the year 2019, 20, 21, 22, and 23. Okay, if we see here in the chart, the EBITDA is increasing on a year on year, so that it is a good sign for a company. Okay, now we have seen what is a EBITDA margin and how to calculate it, and we also seen the example for the Infosys company and the growth of it. Okay, and the PAT margin. The PAT is nothing but profit after tax or net income of the company. Okay, and this also should increase on year while we are analyzing the profitability ratio. Okay, and third one is the return on equity, that is ROE, how much equity the company has. Okay, and for that equity how much profit the company is making, and if we calculate the net income or revenue divided by the shareholders equity, then we can get the ROE. Okay, that is return on equity. As well as if we divide the net income or the net revenue of the company divided by the assets, the total assets, that is the current asset plus non-current asset. Okay, if we add up the current asset plus non-current asset, that is the asset, net income divided by assets, then we can get the return on assets. Okay, and the return on capital employed. A formula to calculate the ROCE is bit complicated. We can see that in the next video in the in-depth way. Okay, the second ratio we are going to analyze is the leverage ratio, that is debt to equity and the debt to asset, that is how much total debt the company is having divided by the total shareholders equity. Likewise, how much debt the company is having and how much divided by the total asset. Okay, the debt to equity and the debt to asset should be lower. That is a good sign for the company. To conclude this video, what all we have seen? We have seen what is a financial ratio, and in that financial ratio there are three types, that is profitability ratio, leverage ratio, and the valuation ratio. The valuation ratio is a very important one. If we are okay with every ratios and the fundamental of the company and business what they are doing and the financial stability of the company, but the main thing we should check is the valuation ratio, that is whether we are buying the share at the correct price or not. We should not overpay for the stock. Okay, the profitability ratio, we have seen what is the EBITDA margin, what is the profit after tax, and what is the return on equity, as well as what is the return on asset. Okay, and in the next video we can see in depth about what is the ROCE. Okay, still then stay tuned. Thank you for watching.